Hello, I'm Troy Harmon. This is Nick Antonucci, and this is your market update from Henssler Financial for May 2018. Nick, what's been going on lately? We'll start there.
I think the best place to start is the most recent data point we got, which was this morning, the employment situation.
Right.
164,000 jobs were added to the economy in April. The expectation was for 193 jobs to be added, so we fell short there. Still enough to keep up with population growth. But on the bright side, the unemployment rate ticked down to 3.9% from 4.1%.
Wow.
So a beat there. Not quite as strong of a jobs number as we would have expected.
Yeah, and that's 2 months in a row,
It
right?
is,
we
yeah.
had,
Last
what,
month
103?
Was, 103. It was a weak report as well.
Yeah, so we have to have 126,000 or thereabouts in order to keep up with population growth. You know, it still beats that. We're still expanding,
Sure.
right? All right, and the other thing, the unemployment number seems very low to me, but there are some people that have called for it to go below 3%.
Yeah, I think 3.8% is the target for year-end 2018, but at 3.9%, this is the lowest level that we've seen since December of 2000. So nonetheless, it's a solid employment picture as it stands right now, despite two, call it weaker months of jobs added.
Yeah, the other thing that's going on, we've got S&P 500 earnings season for the first quarter of 2018. What do we got going on there?
About 80% of the way through. Companies are beating by about 7.2% on average on the bottom line earnings, growing their earnings by about 23.5%. So
yeah. That's pretty solid, right?
Season, yeah.
Yeah. Last fourth quarter of 2017, we came in at about 14.5%. So you know this is added, but our expectations have been high, and that's part of what we've seen in the financial markets. January we came in, ran the market up over 7%. Just in the month of January alone, we're now negative.
Yeah, absolutely, and that pullback in the market combined with the earnings growth that we've seen is making valuation seems a lot more reasonable. You can justify paying the multiples that you can, more so than you could at the beginning of the year or a couple months in when the market had soared an additional 8 to 10%.
Yeah, we're still, you know, at levels that are above the long-term average.
Yeah.
But at the same time, growth is still going strong. I mean, 23% in the S&P 500 earnings. That's pretty impressive.
It is, yeah. I think the last topic we should address covering April is inflation.
Yeah.
Right? We had a Fed meeting. The Fed came out and basically made no changes right now, no interest rate hikes. And the question becomes, is there going to be 3 or 4 rate hikes in 2018?
Yeah.
That's going to be dependent on inflation data. Right now you've got the PCE deflator, which is the Fed's measure for inflation. Right at 2%, the Fed's target. You've got CPI, core CPI, so that's ex food and energy, a little bit higher than that. So the question is, does inflation tick up, and do we justify a 4th rate hike, which would be in December? The market right now says no.
Yeah, I mean, it's all growth dependent, right? Growth drives prices higher. Prices have been going higher, like you said, 2.1 in the core, but it was 2.4 in the headline when you do include energy and food. All things considered, you know, the numbers aren't too bad. 2% is the target. And the options market is telling us we'll have 3 interest increases in 2018.
That's right.
But the Fed has said 4.
Yeah.
Yeah, so who knows exactly what we get. Forward looking, things that we're going to be watching very closely, interest rates and inflation. Inflation, obviously, as we just talked, has been a little bit pressured. It has something to do with employment because usually wage growth is where we start seeing the initial moves higher in prices. Right. We saw some of that, a little bit of a scare in January. It's not been too bad, but when you talk about interest rates, we've had a couple of scares about that lately.
Yeah, we saw 3% on the 10-year, which
exactly.
is a psychological level. A lot of people view that as if the 10-year hit 3%, equity markets are going to fall apart. That obviously didn't happen.
No. Why would it happen? 23% growth in earnings. I mean, this is not a bad thing. Economists would tell us that this is basically a confirmation of the growth. When interest rates begin to move higher, that's basically supportive of that growth in earnings.
And I wouldn't be surprised to see that headline number tick up when you've seen what commodity prices have done. Oil prices are up, I think, 8% this year.
Right. Yeah,
or just in April, rather, 8% just in April on oil prices.
yeah, dollar weakening is a little bit of what's going on behind the scenes there.
Right.
All right, that's been your market update for May 2018 from Henssler Financial. We'll catch you next month.